Hey, good morning, everyone. Chris Lopez here. And this is the first part in a three-part series we're doing on tax planning. And so this one's going to be called Tax Planning 101. So it's be more of a lower level, introductory level where we talk about taxations of rentals, rehabs, brokerage income if you're a broker, and also some basic tax planning strategies. And then the next episode will be called Tax Planning 201, Advanced Strategies for Tax Savings. So we'll get into some more advanced topics such as cost segregation for maximizing depreciation on your property, 179 expensing and bonus depreciation, and then how to avoid self-employment tax and the nuances of the real estate professional status. Then the third episode we're doing is called 303, and that's your exit strategies. So that's how you can start figuring out, hey, how do you want to exit your portfolio or transition your rental portfolio? So I am not an expert on taxes, but like many of you, I want to learn about these because it's a very important part of investing and running businesses. So I asked Peter McFarland of Long Law Group and the Business Innovation Group to come back on the webinars and do these three things. And he was very gracious enough to do it. So Peter, welcome back. Thank you.
Yeah, thank you very much, Chris. And thank you, everybody, for joining me today. Chris did a great job of kind of laying out exactly the vision of where we're going to go here with tax planning and these three different courses. Personally, I'm really excited to do this. It's just funny. These don't necessarily on their face sound like the most interesting topics, but just like Chris said, it's such an important part of investing and understanding exactly, what you're going to wind up paying the government and planning around that, right? And we'll talk a little bit more about what that looks like. So at any rate, Chris mentioned, I'm Peter McFarland. I am an attorney. I'm with the Long Law Group. I'm a partner there. We try as much as possible with the law firm to be a one-stop shop for real estate investors. We do tax preparation, tax planning, real estate law, estate planning. If the IRS comes and knocks on your door, we do controversy work where we resolve issues with the IRS. Basically, anything that you may run into as an investor, we try to be that one-stop shop. But I'm actually more excited today to talk about Business Innovation Group, and that's a picture of my group there. Business Innovation Group is less on the compliance side, and the law firm really deals much more with just being in compliance with what you have to do under the law. Business Innovation Group, on the other hand, takes that to the next level. What we do is more of business advisory and planning. We do revenue and profit improvement, cash flow analysis and forecasting, tax planning and preparation, of course, bookkeeping, business entities, and in particular, real estate strategy and planning. Really what we do is we try to add a lot of value to the basis of your compliance work. And what we can do is actually take really clean numbers, for instance, maybe from your bookkeeper or from ours, and put them through software and actually forecast out where you're going to be, say, 6 or 10 months out, and run what-if scenarios to see what makes the most sense and where you're going to be, depending on those what-if scenarios. So, the way that I kind of view it is that the compliance work is kind of the bare minimum. A lot of business owners or a lot of investors get that compliance work done and pat themselves on the back on a job well done. But my argument would be, well, actually, that's the bare minimum, right? We actually have to keep going and make really informed decisions about your business. And that's what Business Innovation Group really tries to do. So without further ado, I'm just going to get into an opening perspective here. It's not often that I get to get up on a soapbox and kind of talk about some things that I'm thinking about, but Chris was very gracious in allowing me to actually do this. So I'm going to go ahead and talk about an opening perspective. So if I ever do a talk like this in person, I actually ask some questions. And so, Chris, maybe you can help me out with this. But
I'm ready. Fire away.
Excellent. But do you think, Chris, that as time passes, your personal tax situation is going to change?
Absolutely.
Good. That's the right answer. And, it's kind of like one of those like Eastern mythology kind of things, but it's like the one thing that's never going to change is that things are always going to change, right? And so your tax picture for sure is going to change. So do you think that you're going to pay less in tax as a result of tax changes and just time passing? Or do you think you're going to pay more in tax as time passes?
I mean, so my belief and my hope is that personally, my income goes up as I grow and my investments grow up. And my guess is that taxes will go up over the long run as well.
Yeah, and that's I love the optimism, thinking that the income's going to increase. I have that same belief, at least that same hope. But at any rate, yeah, I agree with you. I think that taxes are going to increase. So I used to actually have really great statistics that talked about tax increases over time. But of course, we had the Tax Cuts and Jobs Act that just passed, and so all of our data is really almost useless now because the conversation has changed so much. But there's a really great group out there called the Tax Policy Center. And as far as I can tell, the Tax Policy Center is nonpartisan. But, I don't know. I always take things a little bit with a grain of salt because anything even related to tax, I think, is very political. But at any rate, this graph here is showing us the percent change in after-tax income after the passage of the Tax Cuts and Jobs Act. What's really striking to me is that if you look at the near term, which is that blue, the blue bars on that graph, actually tax change appears to have increased after-tax income for a lot of people, right? None of that's negative really in the blue bars.
So sorry, before we move on,
yeah.
because I'm looking at this and I'm getting a little lost while looking at and hearing you talk. So I assume other people as well, because there's a lot of, I'm just getting my head wrapped on the data on this chart.
It's a thick chart. Yeah.
Yeah. So this is, let me just repeat it and then you can correct me because I feel like others are going to be in the same boat with me. So this is forecasting what people's tax burden is going to be after the recent tax cuts of we passed last year, or in effect last year, for 2018, which is the blue bar, then red bar at 2025, and the yellow bar at 2027. Let's look at those three those 3 years.
Right. So we're kind of projecting those 3 years out, the blue bar 2018, red bar 2025, yellow bar 2027. But what we're looking at is the percent change in after-tax income. So what it's actually saying is, like, let's take that lowest quintile, just that first set of 3 bars there. I suppose that might be like 0.5% or 0.3% or something like that. What it's saying is that individuals' after-tax income in that lowest quintile actually increased 0.3% as a result of the tax changes.
So this is not showing the what they're paying in taxes; it's actually showing how much more money they have in their pocket.
Exactly.
Okay.
Exactly. Yeah. Yeah. And so what's interesting is that my question is, do we think we're going to pay more in tax or less in tax? Well, as a result of tax change, it actually looks like in 2018, at least, people have more money in their pocket. They're actually paying less in tax, assuming that, and this is an assumption. I don't know how far this actually goes. It'd be interesting to dig a little bit deeper, but assuming that this change in after-tax income actually is a result of the tax changes, right? But I think, immediately we all want to jump up and down because, in 2018, all of us are getting more money back. But, there's some interesting things hidden here, which is that, first off, the 95 to 99 percentile, they are benefiting the most, right? As well as the top 1% and the top 0.1%, right? Actually, for most of us who are kind of stuck in the middle quintile or, somewhere kind of in the middle there, the change is significantly less pronounced, right? But what's really striking...
So we're looking at about just under a 2% increase for the middle quintile and right about a 4% increase for the 95 to 99%. Percent of the income earners.
Right.
Okay.
But even though in the short term, it kind of disproves this idea that we're going to be paying more tax, look clear out to 2027, right? The lowest quintile, actually their after-tax income is going to go down, right? Like negative 0.1% or whatever that's going to be. And for the middle quintile and the fourth quintile, it just basically bottoms out. Right. And so I think the long-term trend as a result of the Tax Cuts and Jobs Act is actually that we're going to either break even, or I wonder if we push this even further out with no further changes to tax laws at all. It'd be interesting to see if that actually begins to become negative, right? Because I do believe over time we actually will be paying more in tax.
Now, is that because the law has like sunset provisions where things roll back, or why? I mean, I don't know that much about the new tax law, and I know that's probably a hard question.
It is a very hard question. And yes, I think it is a result of a lot of things sunsetting. But really, if you're interested in digging more at this, what I would do is actually just go on the Tax Policy Center's website, because this graph actually is paired with a really fascinating article And I wasn't able to pick through all of the article as I was throwing together the slides last night. But I'm sure that they break it down a little bit better. But 2027 is certainly a very important year, and it's exactly for what you were saying. A lot of things are going to sunset in 2027. Yeah. So realistically, what we'll see is Congress probably will come back and they'll enact further changes, and either extend things that are working really well or repeal things that aren't working very well and replace them with something else kind of as a test, right? And it's really common when Congress passes laws to kind of do that. They set a period of time and say, well, for this period of time, this is what it's going to be, and things will automatically sunset as of 12/31/2026 or whatever. And then, in November of 2026, they'll pass some like midnight legislation, kind of figuring out what the plan is going to be for the next 10 years. So
yeah, that then all depends who wins the votes and who gets in the office too.
That's absolutely true. Yeah. Are we on a red wave or a blue wave, or what's happening there? So, but I thought that was really interesting. And this is just another way of looking at more or less the same thing. Average benefit from the tax bill there on the left. You can see for the lower income earners, there's really not a lot of benefit, but for the higher income earners, that's really who's benefiting from the tax law changes.
And what would you classify as a higher income earner? I don't know. Is there like a categorization you CPAs use?
For me, it's going to start down in that 200,000 to 500,000 down to the million.
Okay.
Mainly because that's where the significant jumps are. But it's a really hard question to answer, I think, nationwide, because cost of living it varies so wildly, right? I grew up in central Indiana, kind of at the very end of the Rust Belt there. And, there are people there who make $40,000, $50,000 a year, and they live very comfortably, right? Whereas here in Denver, $40,000 to $50,000 a year for the entire household, that would be very hard to make it, right? And so, I think in a way you also have to think about where you are and cost of living and things like that, because if you live back in central Indiana, like I was saying, if your household income is up to $200,000, you're living extremely comfortably, right? But here in Denver, totally different scenario. And then, the right-hand side there, percent change in after-tax income, that's very similar to what we were looking at before. But again, the higher incomes are certainly benefiting a lot more than the lower incomes. So I wish I had really solid numbers, like I was saying back before, that really tell a clear tale that we're actually going to be paying more tax as time goes on. But I think that first slide that I was showing you there, where things are beginning to pare down by 2025, 2026, and then in 2027, almost completely backed out. Just interesting that, to see. And I think it does kind of bear with this trend that we're going to pay more in tax over time. So, increasing tax burdens, it's really the reality for everybody, right? What I make my living doing is tax evasion and not tax avoidance. And Chris, do you know the difference between tax evasion and tax avoidance?
My guess is tax evasion sounds maybe illegal. Tax avoidance sounds legal.
You nailed it. It's a really bad joke amongst tax practitioners, but it's like, okay, the difference between tax evasion and tax avoidance is 10 to 20 years, right? Yeah, and I mean that's how they got Al Capone ultimately, right? Is actually tax evasion. So at any point, we're really talking about tax avoidance here. We're not talking about tax evasion. But tax avoidance, what that is understanding the laws, right? Understanding the tax code. And what we're looking to do is do our patriotic duty, right? We're going to pay every amount of tax that we actually owe. But we're not also looking to make any unnecessary gifts to the IRS, and paying more tax to the IRS than you owe. That's really what it is. It's a gift, right?
Yeah. Wasn't there I might be just making this up. Wasn't there some Supreme Court case in the early 1900s that said, basically, yeah, you have the right to, avoid as many taxes as possible and not just pay as much as possible? Or
I guess I'm not familiar with the specific court case,
and I might be making that up. Popped in my mind.
But that is certainly why my profession exists, right? It's funny because you can even extrapolate it out to, like, say, the criminal context, right? You have an attorney, And the idea is that the attorney and you have attorney-client confidentiality. And that means that you can talk to your attorney, and there are some exceptions, but you can talk to your attorney about pretty much anything. And the idea is that that attorney-client confidentiality exists because the attorney's going to tell you that's a good idea, that's a bad idea, here's the limits, right? Like, and then you can make the decision based on good, solid legal advice about what is legal and what is not legal, right? And there's a lot of court cases upholding attorney-client confidentiality when it comes to really heinous criminal stuff. But nothing was done wrong, just in getting the advice, right? And so that's kind of a weird example and a weird place to go. But pulling it back to the tax context, understanding the battleground, so to speak, is completely legal, right? And asking any question that you want, or asking or kind of getting the lay of the land as far as what that battleground looks like and what the IRS is going to argue, what your counter arguments are going to be, and all of that. That's all perfectly legal, right? The thing is that there you can't say file a fraudulent return, right? And if you come to my office and we talk about that, I'll always say don't file a fraudulent return. But there are limits here, but at the same time, what we're looking to do is our patriotic duty, right? If the tax code and the case law says this is the way that this is going to be taxed, and these are the rules that you have to follow by, and when you run through all of that, this is the dollar figure that you owe, well, that's your patriotic duty. Pay those taxes, right? But on the other hand, you don't have to pay extra. And one thing we're going to talk about in one of the later, a little bit in this presentation, but more in the more advanced tax planning things, is self-employment tax, right? If you're self-employed, you're going to pay relatively more tax than if you had an employer, if you were a W-2 employee. And so, you could pay the maximum amount of tax just kind of blindly and say, well, that's the way that it is. Or you could come to my office and we could talk about setting up an S corporation, and you're going to pay less tax, perfectly legal, and you're not making any of those extra gifts to the IRS, right? And I call those gifts to the IRS because the IRS is never going to come back to you 3 years later and say, you know what, if you took this one planning step, you actually would have paid less tax. Here's your money back, right? They're never going to do that, right? So once you pay it over, it's pretty much a gift to the IRS unless you file an amended return or something like that. So anyways, that's my opening perspective, right? What we're here to talk about is how tax works, and then specifically a few real basic strategies for how we can structure around it and get the best situation that we can. So given that this is really geared for real estate investment, I kind of broke it up based on the type of investment and kind of the tax impact that's going to follow from that type of investment. So first, we're going to talk about rentals. So rental income is somewhat unique because rental income is what the tax code calls per se passive. What that means is that it's passive income, and there's special rules that apply to passive income. So it's not like going out and you have a job and it's a W-2 job and you're earning money in return for your hours at some employer. It's this passive income. Now, passive is a little bit strange to think about because, I have a lot of clients who exclusively run rentals, right? And they have so many rentals that it really is a full-time job, and they're a property manager and they're very active in the management of those rentals. There are special elections and things that you can make, and we'll talk more about some of those in some of the more advanced webinars that are going to come. But the general rule here is that if you have a rental, the idea is that that's passive income, and the IRS views it more or less as a paycheck coming to your PO box or your mailbox, and there's not much else you have to do. Whether that's the reality or not, that's debatable, but that's kind of the default rule. So when I say that it's passive income, what does that mean? What I'm really talking about is that you can think about income kind of as being divided into two different buckets, right? So you have kind of this bucket that represents normal income, and what I call normal income in this case would be like your W-2 wages from a job that you work, your 9 to 5. If you're a contractor, 1099 income would kind of go into that normal income bucket. Capital gain, investment, dividends, those things will go into that normal income. But passive income, here we're talking about rental income and then income from activities in which you do not materially participate. And I'm not going to get much into material participation in this webinar, mainly because it's pretty complicated. But the idea here is just that there's two different buckets, right? And the rental income is going to be separated out from your normal income. So what's the point of these two buckets? Like, why do I even bring it up? Well, the point is that your passive losses, so any losses associated with your real estate, can only offset your passive income, and passive losses cannot offset your normal income, your W-2. So I'm going to add in just a few more buckets here to give you an idea of what this looks like, right? And don't get lost. It's a lot on a slide, but it's still pretty simple. Basically, you'll have income from your activities. That top part really is representing what we already talked about. You have the normal income bucket, which is going to be your W-2 income or your 1099 income. And then you have passive income on the right-hand side there, which is just your rental income, right? Well, you can also have losses, right? And so in the case of a rental, you may actually be taking really large depreciation deductions. And those depreciation deductions on paper may actually wipe out all of your rental income, right? But in some cases, you may actually have more depreciation deductions than you do rental income, right? And so you're actually on paper generating a loss on that rental, even though it's cash flowing, right? And so what a lot of people want to do is they want to take those losses, the losses coming off of the real estate from the depreciation, and they want to offset other income with it, right? Like their W-2 job.
Yeah, let me just pause in because this is, I mean, we tend not to talk about depreciation, the tax benefits from real estate. Very often we do deal analysis unless we do some very detailed, like a long-term financial modeling, just because it gets very complicated.
It does.
But just to kind of, I just want to repeat this point because it's so important when you're looking at real estate, and one of like the biggest gifts you get from the government, I think, for investing in real estate, because you don't get this investing in the stock market, is that the depreciation concept. And that is where for like a residential property, you can depreciate over 27.5 years.
Right.
And then, you know, based on the structure of the property, and then that gets calculated and is basically a phantom loss on the tax document, which is not like you're not really losing money, but helps offset some of your income, right?
Yeah, exactly. So, I've been kind of referring to them as paper losses. And the reason that I use that term is because you're exactly right. When everything hits the tax return, you have this large depreciation deduction. And what it does is just dollar for dollar wipe out the income. So basically, it's like you're showing zero income on the rental or even a loss. One thing that's really cool, and I think I'm planning to talk about it more in one of these later webinars, maybe Tax Planning 201, is the idea of cost segregation studies. And so, like Chris was mentioning, you're depreciating real estate over 27 and a half years, rental real estate over 27 and a half years. Well, what that means is that whatever your purchase price is, you're taking a proportionate amount of that purchase price over 27 and a half years. That's a really long time to recover that cost, right? What a cost segregation study does is it actually comes in and it breaks out the purchase price of the rental property into different constituent parts. And so the idea would be a certain amount of the purchase price, for instance, was paid for carpet. A certain amount of the purchase price was paid for blinds. A certain amount of the purchase price was paying for appliances, or whatever it may be. And you actually break it out into much more granular categories, and then you're going to recover, for instance, certain components of the purchase price, you're actually going to recover over, say, 5 years or 10 years rather than the 27 and a half years, right? And when you do that, in the very first year that you're depreciating the property, you can actually have massive amounts of losses because your depreciation deductions are so large, right? And so just to use a really quick example, because sometimes with numbers, it's a little bit easier. Let's say that you have $30,000 of income from your rental property, right? And so that's passive income. So on this slide, it's going to be in that upper right-hand corner. You have $30,000 of passive income. Well, let's say that you purchased the property for $300,000. You did a cost segregation study, and you have a $50,000 depreciation deduction in year one, right? Well, you have a $20,000 passive loss because $50,000 minus the $30,000 of passive income leaves you with $20,000 of passive loss. Normally, what you're going to have to do is a lot of people, what they want to do is they want to say, well, I made, $100,000 at my W-2 job. Let me take that $30,000 loss against the $100,000 that I earned at my W-2 job. Well, you can't do that. There are ways to do it, and we'll talk more about that in other webinars. But the basic rule is that you can't do that. It's a passive loss, and so it's actually locked away. And what you have to do is carry it forward year after year after year, and you're going to offset other passive income that you earn in the later years with that passive loss. So that's kind of the point of these buckets, to just show you that all of this stuff kind of flows different directions. And unfortunately, anything related to rentals is kind of considered this passive nature, right? It's passive, it's per se passive according to the tax code, which means that you just can't get it over to offset that quote unquote normal income, right? Chris, was that relatively clear? Sometimes I'm talking, I think it makes sense.
Yeah, I mean, I'm familiar with this. I think you did a very good job of it. And I think, to me, the key point for people to take away is just, hey, make sure you have understand those two buckets, as Peter puts it: your normal income, your W-2, your 1099, your business income, and then your passive income from real estate. They're going to be taxed differently. Make sure you understand that, and make sure how they can and cannot work with each other.
Exactly. Yeah. And I clicked one more time because I forgot I put in the little infographic there. But the idea is that, yeah, those passive losses cannot go over to offset that normal income, absent certain elections and things that we can do. But we'll talk more about that in a different webinar. Okay, so that's pretty complicated. To be honest, that's probably the most complicated thing that I'm going to talk about today. So please don't, get discouraged at this point, because I think it's going to get much more straightforward from here on in. But
let me actually ask you one more question on that, on what we were talking about, the rental income. Just, that you got the active income bucket for your W-2, the passive income bucket for your real estate rental. Are those taxed at the same tax brackets? Because the active income is generally a higher tax rate, correct? Or I should probably ask you and not try to think out loud with this.
No, it's fine. It's a little odd because of the way that it actually integrates with the 1040. So what happens is if you have a passive loss, you're actually going to insert that. You run through kind of this ringer on the form 8582, which is kind of what I have over there on the right hand side. So it's going to the 1040, but it goes through this ringer on 8582, and that shows it basically calculates the amount of your passive loss, and then you insert that number on Schedule E. And Schedule E is another ringer where you show all of your rental income and then your expenses, and then you take your passive losses against the remaining income. And so what you wind up with is kind of this like net figure on Schedule E, and then that pops over to the front page of the 1040. So it's actually taxed at the same rate.
Gotcha.
Because it all kind of goes into grossing up your income. And then after that, you're going to take out your adjustments. You get the AGI. And then after AGI, then you're going to get to your actual taxable income and then apply the brackets to it. So really good question. But yeah, it's going to be taxed at the same rate. It's not like a capital gain or a capital loss or something that has its own like special bracket.
Okay. So basically this will still get taxed at your current income tax bracket.
Right.
Okay.
Yeah. Yeah. Really good question. Okay. So moving on. Really here, we can lump the rest of the real estate investing strategies together. Rentals are just unique in the sense that they are kind of that passive investment, but everything else, the same kind of considerations apply. And so really, I'm just going to kind of lump them together. Probably what I'll talk about is maybe interchangeably rehabs and brokerage income. But here we could also be talking about wholesaling, contractors. We could talk about raw land, anything. And Chris, as I'm kind of going, if you want to talk about any of these kind of specific investing strategies or anything like that, I'm more than happy to kind of run it through, because there may be little nuances, but kind of the general idea is more or less the same. But aside from being investments in real estate, the question is like, why can I lump all these together? Like, what do they all have in common? And the answer is self-employment tax. I debated whether I was going to put this on the slide or not, because it just is so stupid. It's like, okay, who pays self-employment tax? Those who are self-employed, right? it's really kind of this meaningless tautology. But the idea here is,
but what means self-employed actually? Let's because that, unless I'm leading. jumping ahead, because
No.
does that mean, hey, I'm a sole proprietor,
Right.
or I have an LLC, like
Right.
an S corp? What is a self-employed person?
Yeah, Chris, you're jumping ahead to the next bullet point.
Okay.
It's perfect. Yeah. So, no, the IRS considers the following people to be self-employed. You're carrying on a trade or business as a sole proprietor or an independent contractor. You're a member of a partnership, and that partnership carries on a trade or business. Or this is where the catch-all is: you are otherwise in business for yourself. Right. So basically, the way that I think about this is: are you a W-2 employee? If the answer is no, then you're self-employed, right? Because of that last catch-all, you are otherwise in business for yourself. It's going to be such a broad umbrella that really everything is going to fall into this. If you look at the IRS publication that talks about who is self-employed, this kind of gives you an idea of the breadth, or kind of how deep this last catch-all, you're otherwise in business for yourself, how deep that really goes. They use an example of a guy who works a W-2 job during the week, but on the weekend he fixes radios in his garage. Right. And sometimes he charges for the work. Sometimes he doesn't. Sometimes he just kind of does it for some buddies or whatever. But other times, people find him because it's the IRS, everything is terribly out of date, but they find him like through an ad in the newspaper, or something like that.
I was already thinking that when you said he fixes radios.
Right. Right. Exactly. Yeah. The old transistor radios with the, he's got vacuum tubes on, bookshelves in his garage. But basically he collects a little bit of money in return for doing this work, and he probably only does it for like 2 hours a week, right? Just on a Saturday morning, he's out there tinkering, right? Well, because he takes money for it, and because he's kind of in business because he's taking money for it, that is self-employed, right? So it can be just a super part-time kind of thing. It can look a lot like a hobby, but basically if you're out there and you're in business for yourself, you're self-employed. So my rule of thumb, as I was saying, is like, well, are you a W-2 employee, right? I get a W-2 from the law firm. So even though I'm a partner, technically, I consider myself more an employee, not self-employed. Not exactly true, but easier example would be if I'm an associate at a law firm, I get a W-2. I'm not self-employed. I'm employed by my employer, right? On the other hand, if you're a contractor, right, if you get a 1099, and this applies really to all of you agents with a brokerage income, you're going to pay self-employment tax, even though you're kind of under the umbrella of the real estate brokerage. Really, you're considered to be self-employed. So, the other way that these are connected, so you can be self-employed. The other thing that you can be is what's considered a dealer in real estate. So what's kind of odd about this is, and I actually, it's funny, about 2 years ago, I did an intake with a potential client. He didn't end up hiring me. But I did an intake with a potential client, and he wanted to do raw land deals, right? And I kind of went through the ringer with him. I'm like, okay, well, how many parcels of land do you think you're going to buy in a year? How many parcels of land do you think you're going to sell in a year? Whatever. And what I came to decide is that actually he was going to be what's called a dealer in real estate. And he said, that's the dumbest thing I've ever heard. There's no way I can be a dealer in real estate. I'm not selling securities. I'm not, whatever. And he actually ended up not hiring me because he just didn't believe that this could be a thing, but it absolutely is. So basically, real estate is what's considered a capital asset, right? And so if you only buy or sell maybe one piece of property a year or something like that, it's a capital asset. And what that means is that you're going to get long-term capital gain or short-term capital gain, right? The problem is that the definition of a capital asset excludes what's called stock in trade. Stock in trade is just a really archaic way of saying inventory. Right. And so if you are buying and selling raw land, for instance, or even rehabs, fix and flips, right, and you cross the line, and there is no set line, but you cross the line where, the number of deals that you're doing in a year actually makes the real estate look like your company's inventory, you're what they consider a dealer. Right. And so if you're a dealer of real estate, you have self-employment tax exposure. So it's another way, you're kind of in business for yourself, first off, but it's another way for the IRS to pull you into this idea that you're going to owe self-employment tax because you're actually a dealer of real estate. Right.
And so if you're considered a dealer, that just basically lumps you into the self-employment tax bracket, or being self-employed versus being able to write these things off as capital gains.
Exactly.
Okay.
Right. So, there's actually, there's a really great court case, and I cannot recall offhand what it is anymore, but what they actually looked at was somebody purchased a really large parcel of land, just raw land, and then they were going to subdivide it and improve it, and basically they came in and graded the land, and then built streets on it, put in plumbing, sewer lines and all of that, and basically they were like dividing this land up to become a development, right? And so the question there was, well, where's the line, right? When did they become a dealer? And offhand, I want to say it was somewhere around like when they sold 4 or 5 lots. That's when the court said, you know what, that's when you're starting to look like a dealer. But don't take that as the bright line rule, right? Because what the court actually did was step through and say, well, when they graded the land, that improved it this much. And, when they put in the sewer lines, it did this and whatever. It was very, very fact driven. And your case is going to be totally different from this case. But, the court really takes this seriously. And there's a body of law that really says, well, at what point do you, when you're selling individual parcels of land, at what point do you actually flip over and become this dealer? And the only reason it went to tax court is because of self-employment tax. The taxpayer was saying, we don't owe self-employment tax. This is capital gain, right? And the IRS was saying, oh no, you owe self-employment tax. You're not paying enough into the system and whatever. And so the tax difference there was enough that it really made sense to push and pay the cost of litigation and everything. And the taxpayer ultimately lost on that one.
So it sounds like if an individual's out there doing 1 or 2 deals a year, they're most likely not a dealer. But if they start doing a handful or more, then they can be categorized as a dealer and get lumped over to paying self-employment tax.
Yeah, I think from a real 10,000 foot perspective, that's exactly right. But again, it's going to be really fact driven. So, if you're in this area and you're kind of trying to figure out whether you're going to owe this self-employment tax, talk to me or talk to your CPA or tax preparer or whatever. They should be aware of this kind of line, and they should be able to look at your facts and kind of get you there. That's the big CYA, of course. But yeah, Chris, from a real high level, you've got it exactly right. Yeah. So anyways, why does self-employment tax matter? Why are we even talking about it, right? Well, in the case of a W-2 employee, the employer normally pays Social Security and Medicare tax, right? All that FICA and FUTA. When you're self-employed, there is no employer, right? You are your own employer. And so the burden to pay for that Social Security and Medicare tax falls on you. And what we're really talking about total is about an extra 15.3% tax. And so there's another slide that I'll do kind of in the later presentations here. This is just a portion of it, but you can see exactly how this kind of plays out. So if we're going to run about $100,000 through a company and it's subject to self-employment tax, the 15.3 self-employment, FICA, FUTA, all of that, that's $15,300. So your net income is now down to $84,700, right? 35% federal and state income tax, that's maybe a little high, but realistic. Your net now is $49,700. And so in this scenario, you actually paid $50,300 there. 15,300 of which is that self-employment tax. So it's significant, right? Particularly as your income increases, it's more and more that you're paying over. And so, a good tax plan and good tax planning is going to look to minimize as much as possible that self-employment tax.
Yeah, I remember learning that when I first starting businesses years ago. Was like, wow. And it's basically I was paying about 50% in taxes as I was a sole proprietor and doing all this. I said, wow, that is a big hunk of money. So that's what got me interested in learning about the tax code. Like, oh yeah, that's a big chunk of money.
Yeah. Typically when I do a talk like this in person and I put up that slide, everybody talks about how demotivating that is, to see half of your income just going out the door there,
Have you ever experienced from just because you talk to a lot of people and clients, have you ever actually seen people say, yeah, I'm not going to try to grow or produce more income just because I'm giving up half to the government, has actually ever demotivated people other than being honest, other than bitching and moaning, which I do my fair share of, but it's actually, I can never think of a situation where it's made me not want to go out and continue growing my business.
Yeah.
Have you actually seen it actually like make people say, yeah, I'm just going to take it easy?
I've only ever seen it once, and it was outside the professional context. It was my brother. And so yeah, but it's funny because the tax system in the United States is what they call a progressive tax system. And so what that means is that the first dollar that you earn is actually taxed at the lowest rate. And then as you work your way up the brackets, only the dollars that are over and above kind of what bumps you out of the bracket are taxed at the higher bracket. So if you have a professional preparer, or I think even TurboTax does it, but there's a summary sheet that kind of gets printed on the front of the page or front of the tax return. And it always talks about kind of like what tax bracket you're in, but then it always has an entry for your marginal tax rate. And your marginal tax rate is actually the tax rate that you're paying because, you know, the first, say, I can't do this offhand with any kind of accuracy, but just for sake of argument, you know, the first $50,000 is taxed at the lowest tax bracket. Then $50,001 to $100,000 is taxed at the next bracket. And when you multiply kind of your total income and step through that process of going through the tax brackets, you get to your marginal rate. So that's how they answered the problem of, well, I'm not going to earn any more money because I'm going to pay more tax because I bumped myself into a higher tax bracket, because really it's only the dollars that you're earning over and above the tax bracket.
And you know, as I'm thinking about this, you know, one of the things, you know, one of the reasons I decided not to pursue flipping, I did one flip a couple of years ago and just was not the thing, not the career I wanted to pursue, or even just doing like some side flips, you know, 1 or 2 a year, because if you're flipping, unless you have it incorporated, you know, put in a corporation, which is a totally different, you know, it's a good thing to do, but it's just more money, more stuff to do. And you have to be doing a certain amount of money from my perspective for it to make sense to do all that. Well, if I'm like, I'm doing 1 or 2 or 3 flips a year, it wasn't worth me doing all the corporation stuff. I was like, man, I'm getting taxed at 50% in the tax bracket. And that's what happened with my first one. I made my, you know, it was roughly $20,000. And I walked away with like $12,000 total. I was like, yeah, that's not worth the risk to reward. It's not there for me.
Yeah, Chris, you're exactly right. I mean, you bring up actually a lot. There's a lot to deconstruct there. You know, anytime you're doing anything that's going to subject you to liability, be it rehabs or rentals or anything, put it in a company. Don't hold it in your personal name. That's kind of the starting point and the first thing that Chris said there. Yeah, you should put it in a company. The question is like, okay, how is the company going to be taxed? And, you know, whatever. There are legitimate tax planning moves and really smart tax planning moves that you can do. But Chris is also absolutely right. You have to look at the cost benefit analysis there, because, you know, a lot of times what we'll recommend is an S corporation. And with an S corporation, you actually have to work with payroll companies, and you have to file quarterly 941s, annual 940s. You know, there's headache, and you know, even aside from cost, there's just headache, you know, associated with it, right? And you're absolutely right, Chris, in the sense that we have to look at the return on what we're doing and saying, is this really worth it? And it's interesting because everybody's tolerance is different to that too. Because I'll look at it and I'll say, you know, I got to be honest, I don't think it really makes sense to do this. But my client looks at it and says, well, I'm absolutely going to do it anyways. Sometimes I'm surprised, but other times I look at it and I say, this is a no-brainer. You're going to save so much money. And they say, I don't want to do it. You know, so it's different for everybody, right? I mean, risk tolerances are different. And then also just tolerances for headache, you know, is kind of different too. So.
But this is why, I mean, because I've been learning the tax stuff the last, I don't know, 12, 13 years of my life. And this is why you learn it. And you always talk with a professional about your situation, because I get about 70% of my guesses right. The other 30% are wrong. And then, you know, professionals tell me, no, this is a way to do it. And here's the real numbers. Okay, great. So I will really emphasize that. Educate, then talk to a professional. And Google is not professional on this matter, because I've made that mistake in the past.
Yeah. You know, it's funny because another thing that I always do, and sometimes I actually feel like I'm a bit of a pink elephant in my profession, in the sense that, like, I'm not real, salesy and I'm not real pushy either. And so what a lot of times I do is I'll make my recommendations, we'll look at it and I'll say, hey, S corporation really makes sense here or whatever, and we look at the numbers and everything. But the number of times coming out of the conference room, I say, you know what, you should sleep on it. You know what I mean? Like you should think about it, take the weekend, talk to your wife, talk to your husband, whatever. Sleep on it. Let me know, here's my card, because it's a big important decision, one way or the other, right? Because if you jump in and you're going to set up a company, you're going to go for the tax planning and all of that, you really have to commit to it, right? Because if you have 1 foot in and 1 foot out, that's where the IRS comes, and that's where the audits come. And that's where, you kind of get into some problems because you were supposed to be doing things and you kind of only followed through halfway, right? That's almost an even bigger problem. So yeah, then the gifts to the IRS actually don't look as bad. So that's not to scare anybody off though, whatever. But all right. So we've talked about more or less kind of the taxation piece, how things are taxed, different treatment for different investments. But let's talk about real basic tax planning strategies here. Some of this will kind of dovetail into the later webinars that I'm going to do, but I just kind of want to introduce some concepts and say, well, we talked about this problem. Here's maybe how we address it, and just kind of some general tax planning stuff. So, the first thing that you want to do, of course, is maximize your deductions. This is not rocket science by any stretch, but if I didn't put this into this webinar, I'd be totally remiss in my duties. But we want to make sure that we maximize our deductions. Really common deductions associated with real estate: your mortgage interest, right? Your real estate taxes, HOA dues, travel, automobile repairs, maintenance, insurance, equipment rental, cleaning, office rental or home office. A lot of people say that that's an audit red flag. I absolutely do not agree with that. I don't think it's an audit red flag.
Why do you say? Because I've heard a lot of people say that is one of the big red flags.
Yeah. Well, there's a new, well, it's not even new anymore, but there's a form that's like basically when the IRS can simplify a form, they put an EZ at the back of it, right? Okay. Like the letters EZ, because it's easy, right? And so it's kind of like a simplified procedure for taking that. If you do that, the IRS rarely has a problem with it. I've done a lot of audits, represented a lot of taxpayers in audits. In the time that I've done it, I've only ever had maybe 1 or 2 examiners really dig in on the home office deduction. The rule there is that it has to be exclusively used for an office, right? And so like if you have a common area like a living room or something like that, if you just have a desk in the corner, that's not going to pass the test, right? But on the other hand, if you have a really great example of one where the examiner like dug in, but then I was able to get the home office deduction even though they dug in, was they had an extra bedroom that was kind of cornered off in like one area of the house that wasn't next to their common area and whatever. It had a door that they could close. One of the things the IRS actually asks and looks for is like, is there a lock on the door? Because you can actually close it off and, the kids don't run in there and distract you or, whatever. There's really no personal use of that space at all. That passes that test. But as I said, I've really only ever seen once or twice where that really became an issue. So I just don't view it as a red flag. As I've, our firm prepares the returns, as I've defended them on audit, very rarely does that, number one, become an issue where there actually are adjustments on the audit. But number two, very rarely does it ever trigger the audit. Normally, the trigger for the audit is something different, like a really large capital loss. Like they take, a $50,000 capital loss and the IRS says, what's going on here, right? Or if you have a Schedule C, if you're like a sole proprietor in business for yourself and you have like 6 years consistently of losses, you never show any income, right? That triggers an audit, right? I mean, typically it's something different and bigger, right? But I've never seen one where it was just the home office that triggered it.
That's good to know.
Yeah. Commissions, professional management fees, utilities, supplies, right? Now, meals and entertainment, I kind of cornered off there. And the reason is because with tax law changes, actually entertainment is now out the door. You cannot deduct entertainment. but you can deduct meals. So actually, I should have just put meals there. But
so what's the difference? Because I've always lumped them when I've done my, my Quicken or my Quicken type software for my own, download my statement every month, categorize. I just have meals, entertainment.
Yeah.
Obviously, so a meal will just be, hey, go out, eat a meal. That's a meal.
Right.
Entertainment is if it's, hey, you go to the baseball game afterwards, or you go have drinks afterwards. Like what's the differentiator between those two?
Yeah, good question. The baseball game is always the example that I use, and the reason is because I love going to the Rockies. Tickets are so cheap; it's amazing. But no, anything that is very much just entertainment based, you know what it looks like: going to the movies, baseball game, anything like that. That's no longer allowed at all, right? And so what you're going to look to do, the drinks is actually kind of, for me, that's a really gray area. I would lump drinks in with meals.
Okay.
I would just take that position. And then if you have mixed use, right? So there's a little bit of meals and a little bit of entertainment on the same receipt. What you need to do is look at the itemization, and then the amount that's actually the meal you can deduct, but the entertainment bit you're not going to be able to.
Now, one of the rules of thumb that I used, and this may be incorrect, may not be correct anymore, was I think it was like if the meal and entertainment back then, if the meal is less than $70, no receipt is needed. If it's more than $70, keep a receipt and label on the back. I don't know where I heard this from, but it's the rule I've been going by for over a decade.
Well, yeah, you're not going to like me.
All right. So, yeah. Well, we'll erase that part then.
Yeah, strike it from the record. We'll take that out in post. No, I mean, the strict compliance rule is that you have to have all of the receipts. And the reason is because typically, and actually this gets into another point here, typically your guidepost when it comes to these deductions is that they have to be ordinary, necessary, and reasonable, right? And that comes out of section 162 in the code. Meals and entertainment is actually governed by 162. It has to be ordinary, necessary, and reasonable, but then it also is governed by 274D, which has heightened substantiation requirements. And the reason is because the IRS recognizes that there's a real potential that you're going to abuse meals and entertainment.
Yeah.
Right. And so as a result, particularly in that kind of 274 land, the heightened suspicion kind of thing, you really do need to have all of those receipts. And in addition to that, you actually need a log, and the log needs to say, who did you meet with? What did you talk about? Where were you? Why is it business related, right? Kind of the who, what, when, where, and why, right? Because what happens is that the IRS, and this goes along with travel as well, right? So it's travel, meals, and entertainment are almost the hardest thing to prevail on if the IRS comes and audits, just because these substantiation requirements are so difficult. But what they do is they kind of tried to make you recreate your calendar and just say, look, what trips did you take? When did you leave? When did you return? Where did you go? Who did you meet with? What did you talk about? Why is it business related? And of course, not everything is going to be business related, right? On these trips. I mean, eventually, you may even do like a partial use trip where, you stay over a couple extra days or whatever, just to hang out and have fun, right? That's okay. That doesn't disallow everything on that trip. But the IRS wants to know that. They want to see the breakdown so they can figure out actually what is deductible and what isn't deductible. So, I mean, to strictly answer your question, Chris, I think you have to have everything. But that said, you also wind up with a human being who's auditing your return, right? And this is not the technical compliance answer here, but it's kind of the I have some experience here and I've done this before answer. Sometimes you get an auditor who's very reasonable, and sometimes you get an auditor who's very unreasonable. And if your auditor is very unreasonable, if they don't have exactly what the code requires, they're going to disallow the deduction, right? Some auditors will look at your QuickBooks report or your Quicken report or whatever and see, all of the entries, and they'll see, they may be able to piece together some trips, and then they'll say, well, okay, a couple fast food joints, whatever. I'm not really interested in things that are under whatever dollar figure. But then they see like a charge to a steakhouse for $200, right?
Yeah.
And they say, okay, show me that receipt, and so it kind of depends on your audience and who you're playing to. But the strict compliance answer is that you need all the receipts. Does that make sense?
Yeah, that makes sense.
Yeah. Yeah. So, ordinary, necessary, and reasonable is really your guidepost there. What's really funny too, I can tell you another quick war story. I'm going through an audit right now, and I set up a lot of business entities, right? And part of your business entity thing is that you have to have an annual meeting, right? The example that I use is, okay, ordinary, necessary, and reasonable. Going out to a nice meal here in Denver for your annual meeting, probably ordinary and necessary, okay, depending on where you go, probably reasonable too, right? The example that I use is don't go to Fiji, right? An annual meeting is ordinary and necessary, but going to Fiji for your annual meeting is not reasonable, right? So here I am, audit, still going on, and my taxpayer went to Fiji for his annual meeting. The exact example that I use of what not to do, now I'm defending that. So ordinary, necessary, and reasonable, that's your guidepost, right? All right. Another really good tax planning strategy here is to distinguish between repairs and improvements on your properties. The reason that this is important is because repairs are currently deductible and improvements are not. You have to depreciate improvements. So the idea here is that if you can repair something, repair it, don't replace it, right? If you can repair a wall rather than replacing the wall, or you can repair the roof rather than replacing the roof, that's going to be a better tax strategy than replacing it. Now, on the other hand, if the roof's in really bad shape, do what's right for your investment, right? If you actually need to replace it, by all means, replace it. But if there's the option, always good to repair. The way to know the difference is that repairs are keeping your property in good condition, but it's not extending the life of the property like a new roof would, right? Improvements, on the other hand, that's prolonging the life, or it's adapting your property to some kind of new use, right? Just other really quick general strategies. You can create a company to manage your rental properties, and that may actually generate some deductions that you otherwise wouldn't get. You can hire your family to manage your properties, and actually that can shift income to lower tax brackets. It can also help somebody get a retirement plan set up, or maybe an HSA or an FSA, some other tax planning strategies around that. And then we'll talk more about exiting strategies, but you can look at using an installment sale to sell your property. And then in that case, you can defer when you actually have to pick up that income on your tax return, or there's always a 1031 exchange you can look at. So we talked about rental real estate and the fact that passive income or passive losses can't offset active income. A really great way to avoid that situation and use the passive loss to offset your active income is to become a real estate professional. And when we record it and get it up, see Tax 201, right? We're going to talk a lot about that in that particular webinar. But because I kind of brought up the problem, I thought I should at least mention the solution. And then the same thing with self-employment tax. The answer here, and we really kind of danced around it before, is to create an S corporation. And if you're interested in learning more about why an S corporation kind of dances around self-employment tax and can get you a little bit of planning opportunity there, I'll touch a little bit on it in Tax 201, but specifically the biggest part is going to be in the business entities webinars that we're going to do, and I think that's going to be in 301.
Yeah, and so just to clarify, so I did not mention this at the beginning of this episode, but we're actually doing 2 3-part series. So right now we're doing the tax ones, and then very soon after we record these, we're going to record and publish a 3-part series on business entities. So as you're going through this, listen to the recording, keep your eyes out for those, get all the details, because they will be there.
Yes, excellent. So just a quick recap, right? Taxation of rentals, it's per se passive. It's going to result in passive income. Taxation of all other activities, we're looking at potential self-employment tax concerns there, right? And then your basic tax planning strategies, just, we had some general strategies there. We're going to look at real estate professional in the presentations to come, and then maybe an S corporation as well. But, just kind of a final little thought here. Team cooperation is essential, right? Especially as you're going through tax planning or building your investment portfolio, building your businesses. And I just want to let you know you're not alone, right? Certainly keep Chris and then also Business Innovation Group in your back pocket. we're more than happy to answer questions as they arise. And you can always email info@bigprofitsolutions.com to kind of get in touch with me and kind of get the ball rolling there. So with that, I'll open it up to any questions if we have any.
I think we don't have any questions. We did a good job. I just have to do kind of a question on the business innovation group. That sounds like a very impressive, company you started just with, the advanced planning you can do on there. Like when should a person or a company, because a lot of our viewers are like myself, we're independent, or might be a husband wife team or a very small team of 2 or 3 people. Mm-hmm. Like, at what point are they big enough to get those more advanced tax planning strategies, or is there no floor for that? I'm curious for myself as well.
No, it's a very good question. So Business Innovation Group, actually, we have different packages and different kind of suites of services. A lot of our packages or suites of services are geared at maybe larger companies with employees, 14, 15, 30 employees, whatever. But we actually have created a specific suite of services and packages for real estate investors, because on the long law group side of things, on the compliance side of things, we've worked with investors for years, right? And the vast majority of our clients really are involved in real estate and real estate investing. And so we understand real estate, and we also understand real estate investors, and we understand exactly what it's like to be just you or that mom pop kind of husband and wife team, right? And so no, Business Innovation Group absolutely has real estate investors in mind and can work with you kind of based on your needs and where you are. It probably is better for investors who are up and running rather than those who are just starting out, maybe don't have an investment yet or looking to get their first one. That doesn't mean that I can't help you, because what I can do is help you more on the law firm side of things, in terms of just getting the compliance bits in place, kind of the bones of the structure, right? And making sure that you're compliant and running well there. But then in the future, when you have kind of a running history and you're starting to grow, that's really where Business Innovation Group can come in and then help you kind of take that to the next level.
So you're probably going to hate this question, Peter, but I always, because when it comes to, when it comes to stuff, it's like, cool, hey, you're making, a certain amount of income every year, and it's usually small, medium goes bigger with investing.
Right.
Is there like, hey, you're bringing in, one property. Hey, I'm making about $50,000 a year in profit. Is there kind of like a threshold that makes sense? Because, hey, cool, if I'm making $30,000 a year in passive income, and I can, does it make sense? I don't know. And I'm throwing out magical, made up numbers now. Right. Making $30,000, is it worth spending, I don't know, $5,000 in consulting to save $500? It's not worth it. Is there like, Can you give me a threshold here?
Right. Well, I don't really have a threshold. Okay. And the reason is because actually what we do is we get to know what your picture looks like, and then we build the package around that. Right.
Gotcha.
And it's really more, I hate this term, but for lack of better term, it's really more value pricing, in the sense that what I do is I come in, I look at where you are, I see what I think I can do for you, and then based on what I think your return is, I build my fees around that. Right. And so if I'm only going to generate $500, I'm going to say this isn't even worth it. Right.
Yeah.
I mean, for either of us, really, because, all I'm going to do is set you up for disappointment. But on the other hand, if I come in and I see real potential, and I think I can actually increase your profitability by 40% or whatever it may be. That's a big number, but it's not unheard of. But I'll look at that and then say, well, yeah, I think that this price makes sense, and we can kind of go from there. It's really, I guess, geared more at your circumstances and maybe what I think I can generate for you, because ultimately what I want to do is get you a return that not only pays for my fee, but actually propels you forward. Right.
Yeah.
Yeah. And so it's going to be different for everybody, kind of depending on where you are and how much work is going to be needed. Because the other thing too is, for some people, it may just be like 1 or 2 strategies and you're going to get off and running even better. Right. But for other people, it may be really stripping down kind of the existing practices and things. And, that's going to take a lot more. Right. So
Perfect.
I don't know. Yeah.
No,
It's a really like vague way to dance around all of that, but it's really true.
No, that gives me the gist I was looking for. So awesome.
Yeah.
All right. Well, Peter, thank you for doing this. I'm looking forward to do the 201, the 301, and these business entities because I'm doing them because great. It's great to post on the internet for clients. It's also great for me to learn. So I appreciate it. And as you're watching this recording, there'll be a link somewhere near here to take you on to the next ones. And if you have any questions on the real estate investing side, feel free to reach out to me. If you got questions on taxes and business entity and legal stuff, definitely do not reach out to me. Reach out to Peter and his office because they are the experts there and they're the people I usually forward those emails to. So, Peter, thank you so much.
No, thank you. Yeah. Cool.